In 1929, stocks rallied 48% after the initial crash. Investors declared the worst was over. The market then collapsed 89% over 3 years. In 2000, the Nasdaq rallied 42% after its spring correction. Tech bulls announced the bear market had ended. The index then crashed 78% over 2 years. In 2007, the S&P 500 hit all-time highs in October. 5 months later, the worst financial crisis since the Great Depression destroyed 57% of market value. Every major crash in history was preceded by a euphoric rally that convinced everyone the danger had passed. And right now, November 2025, we're inside another one. The S&P 500 just surged 37% in 7 months. Investors are celebrating the soft landing, but consumer sentiment hit 50.3, the second lowest reading in history. October saw 153,000 job cuts, the worst October in over 20 years. Commercial real estate double defaults surged 90%. This is the pattern. This is the cycle. And America just entered stage 5, the hidden 18-month pattern. What if I told you every debt crisis follows the exact same pattern? A pattern that takes precisely 18 months to complete. A pattern Wall Street knows but never discusses publicly, because by the time the public sees it, it's too late. Let me show you the 5 stages. Stage 1. The crack. Month 0. Something breaks. A bank fails. A sector collapses. Markets panic. This is the warning shot everyone dismisses as isolated. Stage 2. The rescue. Month 1 through 6, central banks intervene. Emergency measures deployed. Markets stabilize. Media declares crisis averted. This is the false calm. Stage 3. The rally. Month 6 through 12. Markets surge to new highs. Bears capitulate. The public rushes back in. This is the trap. Maximum people at maximum prices. Stage 4. The hidden rot. Month 12 through 15. Beneath the surface, everything deteriorates. Credit metrics worsen. Layoffs accelerate, but stock prices keep rising. The divergence grows deadly. Stage 5. The cascade. Month 15 through 24. The delayed collapse arrives. What was hidden becomes undeniable. Selling feeds on itself. The mathematics take over. This isn't theory. This pattern repeated in 1929. It repeated in 2000. It repeated in 2008. The 18-month cycle is as reliable as gravity. So when did the current cycle begin? Not March 2023 when banks failed. That was just noise. The cycle begins at peak complacency, the moment everyone believes the danger has passed. That moment was September 2024. The yield curve normalized after 27 months inverted, the longest inversion in history. The Federal Reserve declared victory over inflation. Economists announced the soft landing had arrived. Media headlines read, "The recession that never came." September 2024 was month 0. November 2025 is month 14. Stage 5 begins now. The 18-month pattern is completing exactly on schedule. This isn't prediction. This is pattern recognition. The cycle always completes always. September 2024, month 0. The yield curve normalized after being inverted for 27 months, the longest inversion in history. This indicator has predicted every recession since 1950 with 0 false positives. The normalization doesn't mean safety. It means recession begins 3 to 12 months later. The average is 8 months. That puts us at May 2025, but the market didn't care. The Federal Reserve declared inflation conquered. Economists announced the soft landing achieved. The media ran headlines celebrating the recession that never arrived. This was stage 1, the moment of peak complacency when everyone stops worrying. Then came the rescue in stage 2. The Fed began cutting rates 75 basis points through the fourth quarter of 2024. More cuts promised for 2025. Commercial real estate loans that should have defaulted got extended. $957 billion in maturing loans restructured. Banks used modifications to delay recognizing losses. Regulators allowed the strategy called extend and pretend. It bought time but didn't fix anything. Artificial intelligence became the new narrative. NVIDIA announced $500 billion in chip orders for 2025 and 2026. Every company added AI to earnings calls. Tech stocks surged on promises of future productivity. The surface looked perfect. Unemployment remained at 4.3%. GDP growth stayed positive. Corporate earnings beat estimates 82% of the time, the highest since 2021. The stock market rallied October 2024, November 2024, December 2024, January 2025, new highs every month. By April 2025, the S&P 500 had bottomed after a brief tariff scare and began the most powerful rally in years, 37% in 7 months. This was Stage 2 completing and Stage 3 beginning. The rescue created the illusion of safety. The rally convinced everyone the cycle had been broken, but Stage 2 never fixes the underlying disease. It only delays the symptoms. The debt remains, the valuations remain, the structural problems remain. All Stage 2 does is set up Stage 3, the euphoric rally that traps maximum people at maximum prices right before Stage 4 begins. Stage 3 is the most dangerous phase of any debt cycle, not the crash. The rally before the crash, because this is when psychology overrides mathematics, when hope replaces analysis, when the public rushes in just as the smart money exits. Right now, November 2025, we are living through Stage 3. The S&P 500 surged 37% from its April low. The Nasdaq gained 42%. Magnificent 7 stocks pushed markets to all-time highs by summer. Every dip was bought, every correction was shallow. The fear of missing out became stronger than the fear of losing money. Media declared the bull market unstoppable. This is the pattern. This is always the pattern. In 1929, after the initial October crash, stocks rallied 48% by April 1930. Investors flooded back in. Economists said the worst was over. The market then collapsed 86% over the next 2 years. Those who bought the rally were destroyed. In 2000, the Nasdaq crashed 40% from March to May. Everyone panicked. Then it rallied 42% by September. Tech analysts declared the bear market finished. The correction is healthy, they said. Buy the dip, they said. The Nasdaq then crashed 78% over 2 years. In 2007, subprime mortgage problems emerged and August markets dropped 10%, then rallied to new all-time highs by October. Lehman Brothers CEO told investors the worst is behind us. 5 months later, Lehman collapsed. The S&P 500 fell 57%. The pattern repeats because human nature doesn't change. Stage 3 always feels safe. The rally feels real. The fundamentals seem strong. The experts sound confident. But beneath the surface, everything is breaking. Look at what's actually happening in November 2025. Consumer sentiment hit 50.3, the second lowest reading in history. The only lower reading was during COVID lockdowns. But stocks keep rising. October 2025 saw 153,000 job cuts announced, the worst October in over 20 years. But stocks keep rising. Commercial real estate double defaults surged 90% to $5.5 billion. But stocks keep rising. Long-term unemployment hit 25.7% of all unemployed, nearly 2 million Americans out of work for 6 months or more. But stocks keep rising. This is the divergence. Stock prices detached from reality. Valuations detached from fundamentals. The S&P 500 forward price-to-earnings ratio sits at 22.7, well above the 10-year average of 18.6. In late October, it briefly exceeded 23, a level only reached once in the past 25 years before the 2020 bear market. Do you know what happens during Stage 3? Insider selling accelerates. Corporate executives who see the real numbers dump stock at record pace. Warren Buffett's Berkshire Hathaway sold hundreds of billions throughout 2024 and early 2025. Yes, Berkshire recently bought Alphabet, but that was his investment managers, not Buffett himself. His overall posture remains defensive cash holdings near record highs. The smart money is not buying this rally. They're using it to exit. Hedge funds that were heavily short have covered, but they're not going long. They're moving to neutral, waiting. Institutional investors are rebalancing away from equities. Not dramatically, just quietly reducing exposure. They see what's coming. Stage 3 always ends the same way. The rally runs out of buyers. The last optimist has already bought. There's nobody left to push prices higher. And then Stage 4 begins. The hidden rot becomes visible. The divergence can no longer be ignored, and the trap snaps shut. Stage 4 is where the mathematics start overtaking the narrative, where the fundamentals begin breaking through the optimism, where the cracks that were hidden in Stage 3 become impossible to ignore. We are in Stage 4 right now, November 2025, and the deterioration is accelerating. Start with the labor market. Everyone focuses on the unemployment rate, 4.3%. Historically low, sounds healthy, but that's a lagging indicator. It tells you where you've been, not where you're going. The leading indicators tell a different story. October 2025 had 153,000 job cuts announced. The worst October in more than 20 years. Amazon announced layoffs. UPS announced layoffs. Tech companies, financial firms, retailers all cutting thousands. These announcements happen months before people actually lose jobs. The unemployment rate will catch up. It always does. Long-term unemployment is already spiking. 25.7% of all unemployed workers have been out of work for 27 weeks or more. That's nearly 2 million Americans, the highest level since COVID. When long-term unemployment rises, it signals the job market is softening significantly. People aren't just between jobs. They cannot find jobs. Consumer sentiment has collapsed to 50.3 in November, the second lowest reading in history. Think about what that means. The stock market is near all-time highs. Unemployment is low. GDP is growing. Yet consumers feel worse than almost any time in recorded history. Why? Because they see what's coming. Prices are still elevated from inflation. Wages haven't caught up. Credit card balances are at all-time highs with delinquencies rising. Savings are depleted. 78% of Americans live paycheck to paycheck. They feel the pressure even if the official statistics don't show it yet. Now look at commercial real estate. The extend and pretend strategy is failing. Double defaults hit $5.5 billion in September, up 90% from the previous year. What's a double default? It's when a borrower gets a loan modification, temporary relief, and then defaults again anyway. This proves the modifications aren't solving the problem, they're just delaying it. $957 billion in commercial real estate loans mature in 2025. Most got extended in 2024, but you can only extend so many times. Eventually, the bank must recognize the loss. Office buildings sit 19.6% vacant nationally. San Francisco is at 29.4%, New York City at 22.1%. These buildings were financed at 3% interest rates. Now they must refinance at 7 to 9%. The properties aren't worth enough to support the debt. The math doesn't work. Commercial mortgage-backed securities show delinquency rates of 7.29%. The highest distress level in the sector. Regional banks hold 70% of all commercial real estate loans. When these loans default, regional banks take the losses. Their capital ratios will collapse. Some will fail. Look at valuations. The forward price-to-earnings ratio of 22.7 means investors are paying $22.70 for every $1 of future earnings. The 10-year average is 18.6. We're 22% overvalued by that measure. But it gets worse. The Shiller-Cape ratio, which smooths earnings over 10 years, recently exceeded 38. This level has only been reached twice before major crashes, in 1929 and in 2000. Both times, stocks fell more than 70%. Earnings growth for 2025 is projected at 11.6%. That sounds good, but it's based on assumptions that revenue growth continues. What happens when consumer spending crashes? When layoffs accelerate? When recession arrives? Earnings collapse. And at 22.7 times earnings, there's no margin of safety. Here's the critical point about Stage 4. All of this is happening right now, but the stock market hasn't reacted yet. Prices keep rising even as fundamentals deteriorate. This creates the divergence. And the wider the divergence grows, the more violent the snapback becomes. In 2008, the fundamentals started breaking. In 2007. Subprime delinquencies rose. Home prices started falling. But stocks hit new highs in October 2007. The divergence grew for 6 months. Then Lehman collapsed and stocks fell 57% in 18 months. In 2000, corporate earnings started missing. In late 1999, revenue growth slowed. But the Nasdaq kept rising to its peak in March 2000. The divergence grew for 4 months. Then the selling began, and the index crashed 78%. Over 2 years, the divergence cannot persist forever. Eventually, prices must reflect reality. That's when Stage 4 ends and Stage 5 begins, the cascade. Stage 5 is when the delayed collapse arrives, when mathematics overpower narrative. And it happens faster than anyone expects because modern markets are built for speed. Here's exactly how it unfolds. The trigger. A major tech company reports AI spending isn't generating returns. Nvidia or Microsoft stock crashes 15% in one day, or a regional bank announces billions in commercial real estate losses. Stock falls 40%. Depositors panic. The specific trigger doesn't matter. Any shock starts the cascade. Week 1 through 3. Markets drop 20%. Margin calls begin. Investors who borrowed money to buy stocks must provide more cash or brokers sell automatically. Forced selling drives prices lower. More margin calls, more forced selling, the death spiral that killed 1929, week 4 through 8. Credit markets freeze, zombie companies cannot refinance debt, bankruptcy announcements multiply, corporate borrowing stops, layoffs that were announced get executed, unemployment spikes from 4.3% to 6% in weeks, consumer spending collapses, week 9 through 12. Regional bank fails, commercial real estate losses too large to hide. FDIC seizes bank Friday evening. Monday morning depositors line up at similar banks withdrawing money. Classic bank run. Banks must sell assets at losses to raise cash. More banks fail. The $125 billion FDIC fund depletes week 13 through 24. Markets down 50 to 60%. Our unemployment hits 10 to 12%. Housing prices fall 30%. Federal Reserve cuts to zero. Announces massive quantitative easing, but it doesn't work like 2008. Everyone remembers printing money caused 9% inflation. The dollar falls. Stagflation arrives. Recession and inflation simultaneously. By month 24, markets have fallen 65 to 75%. Unemployment reaches 15%. Recovery takes years, not months, because the tools that saved us before no longer work. This is stage 5. We're in month 14. The trigger comes soon. The mathematics guarantee it. Why tools are exhausted? In 2008, the Federal Reserve had powerful weapons. Interest rates stood at 5.25%. Room to cut all the way to zero. They did. They implemented quantitative easing, buying trillions in bonds. The government borrowed to bail out banks because federal debt was only 67% of GDP. These tools worked. Markets recovered in 5 years. But in 2025, every tool is exhausted. Start with interest rate cuts. The current Fed funds rate sits at 4.5% after cuts through 2024 and 2025. That seems like room to cut. Until you realize inflation just came down from 9%. It's currently 3.4%, still above the 2% target. If the Fed cuts aggressively, inflation reignites. The 1970s proved this. The Fed cut rates in 1975 trying to help the economy. Inflation surged to 14.8% by 1980. It took 2 recessions and 20% interest rates to kill it. The Fed cannot make that mistake again. Next, quantitative easing. The Fed's balance sheet sits at $7.4 trillion. Before 2008, it was $870 billion. The Fed already owns massive portions of the bond market. Everyone now understands quantitative easing equals inflation. The 2021 to 2023 experience proved it. $5 trillion printed, 9.1% inflation. Wages couldn't keep up. Savings destroyed. If the Fed tries massive QE again, the dollar collapses. China has already reduced treasury holdings from $1.3 trillion to $770 billion. Japan is reducing purchases. If the Fed becomes the only buyer, international investors flee. Reserve currency status at risk. Finally, government bailouts. Federal debt stands at $36 trillion, 123% of GDP. The government pays $1.1 trillion just in interest annually. That's more than the entire 2008 bailout every single year just to service debt. A 2025 banking crisis would require $3 to $5 trillion in bailouts that would push debt to 145% of GDP. History shows what happens at 150%. Bond markets revolt. Greece, 2010. Italy, 2011. Interest rates spike. Borrowing becomes impossible. The debt spiral unstoppable. The tools that saved the system in 2008 don't exist in 2025. Rate cuts risk inflation. Money printing destroys the dollar. Bailouts push debt past the point of no return. There is no good option, no easy fix, no cavalry coming. This is why Stage 5 will be worse than anything we've seen, not because the problems are bigger, but because the solutions no longer work. Let me show you what Stage 5 means for real people. For the retiree with $600,000 in their 401k, you spent 30 years saving, you're 68 years old. When markets fall 65%, your account drops to $210,000. You cannot retire. You must work another decade. Assuming you keep your job through the recession, your retirement is gone. For the young professional who just bought a home, you purchased in 2024 at peak prices, $600,000 home, $540,000 mortgage. When housing falls 40%, your home is worth $360,000. You're underwater by $180,000. You cannot sell. You cannot move. You're trapped for 15 years. For the small business owner, your restaurant or retail shop depends on consumer spending. When spending drops 25%, your revenue collapses overnight. But rent continues, payroll continues, you drain savings trying to survive. By month 4, you declare bankruptcy. Everything you built for 20 years is gone. For the college graduate entering the workforce in 2026, no entry-level positions exist. The jobs that do exist have hundreds of applicants. You start your career 5 years behind where you should be. Studies show recession graduates earn 10 to 15% less over their entire lifetime. Your economic future is damaged before it begins. This isn't just numbers on a screen. This is real lives destroyed, real futures stolen, real suffering that spans decades. 30 million retirees will see savings evaporate. 15 million homeowners will go underwater. 8 million small businesses will fail. 20 million young people will have careers permanently scarred. This is the human cost of Stage 5. And it's coming. So here's the precise timeline. September 2024 was month 0. The yield curve normalized. Peak complacency arrived. Everyone declared the recession that never came. November 2025 is month 14. We are in Stage 4, transitioning to Stage 5. The hidden rot is becoming visible. December 2025 through February 2026, month 15 through 17, highest probability window for the trigger event. Fourth quarter earnings season reveals AI spending not generating returns or commercial real estate extensions expire and banks must recognize losses. Or, consumer spending data for holiday season shocks economists, the trigger arrives, Stage 5 begins. March through June 2026, month 18 through 21, the cascade accelerates. Markets fall 40 to 50%. Credit freezes, banks fail. Unemployment spikes to 8 to 10%. Emergency Fed interventions begin but prove insufficient. July through October 2026, month 22 through 25, the bottoming process. Markets down 60 to 70% total. Unemployment reaches 12 to 15%. Massive quantitative easing announced. Government stimulus debated. The worst of the collapse visible to everyone. November 2026 and beyond, month 26 forward, slow recovery begins, but takes 8 to 15 years to return to 2025 levels. Japan's crash in 1990 took 34 years to recover. America's crash in 1929 took 25 years. This combines elements of both. The 18-month cycle from peak complacency to cascade completion is mathematical. September 2024 plus 18 months equals March 2026. We're in month 14. Stage 5 is imminent. The indicators have triggered. The pattern is completing. This isn't speculation. This is mathematics. The crash isn't coming. We're already inside it. The only question is whether you'll be ready when Stage 5 arrives.